Mr. AG here, Asian guy bringing you the complete picture. JP Morgan allegedly closed their massive silver short position at the exact intraday bottom of the biggest silver crash in 44 years. Not close to the bottom, not near the bottom, at the exact bottom. When you add in the London Metal Exchange going dark that same morning, HSBC's trading systems going offline in Hong Kong at the same time, and a sudden aggressive CME margin hike forcing leveraged traders to liquidate, the story stops looking like normal market volatility and starts looking like something else entirely. Today, I'm going to walk you through every piece of evidence, show you the timeline that most mainstream media is ignoring, and let you decide for yourself what actually happened. Because this is the kind of detail that makes even veteran metals traders sit up and pay attention. Before we go any further, let me be absolutely clear about something. I do not sell courses, I do not sell signals, I do not sell mentorships, I do not have any paid products of any kind. I share this analysis because so many of you have told me this content helps you understand what is really happening in markets, see angles that mainstream media ignores, and make more informed decisions. That is why I do this. I present the evidence. I show you both the official narrative and the alternative explanation, and I let you decide. Now, let me get into what actually happened, because this timeline is something everyone holding precious metals needs to understand. Drop a comment right now. Where are you watching from? What country? What city? I want to see how global this community has become. And while you're down there, tell me what you think happened on January 31st. Do you think this was a natural market event? Or do you think something else was going on? I want to hear your honest take. Let me know in the comments. Now let me set the scene for what happened. In late January 2026, silver spiked to around $117 an ounce. Then it rose further to around $120 on Thursday. Everything looked bullish. Momentum was strong. The rally seemed unstoppable. And then Friday happened. Silver crashed from $120 to roughly $78, a 35% intraday wipeout, the worst silver day since 1980. Let me repeat that. The worst single day for silver in 44 years. Gold dropped about 12% in the same window. And the move in silver was so violent that analysts described it as a 6 sigma event. For those unfamiliar with that term, a 6 sigma event is statistically supposed to happen roughly once every 1.5 million trading days. That is approximately once every 6,000 years. And yet, here we are. The mainstream headlines quickly blamed the crash on macro factors. Donald Trump's nomination of Kevin Warsh, seen as a hawkish replacement for Jerome Powell at the Federal Reserve, allegedly torpedoed expectations of easy money and sent the dollar sharply higher. In this narrative, crowded long positions in gold and silver simply imploded when the Fed's accommodative stance shifted. Over-leveraged bulls got caught on the wrong side. It was just a crowded trade unwinding. Nothing more to see here. But there is another narrative, and it is supported by a sequence of market plumbing events that day. Systems going down, margins going up, shorts allegedly closing into the panic that suggests to many observers that the macro story was at best a convenient cover for something more deliberate. Let me walk you through the timeline, because the sequence of events is where this gets really interesting. As silver began to roll over on Friday morning, the London Metal Exchange, one of the world's key venues for metals trading, had what was described as a pre-market glitch. This glitch delayed the start of electronic trading. At the same time, in Hong Kong, HSBC, a major London Bullion Market Association participant, also reported trading systems down. 2 major trading venues experiencing technical difficulties at the exact moment silver begins crashing. The timing is either extraordinarily unfortunate or extraordinarily convenient, depending on how you view these things. In parallel with these system outages, CME Group's COMEX division hiked margin requirements on silver futures. This was not a small adjustment. This was an aggressive hike that came just as liquidity was thinning heading into the weekend. What does a margin hike do? It forces highly leveraged traders to either wire in fresh collateral within hours or dump their contracts into a falling market. If you are leveraged long on silver and suddenly your margin requirement jumps significantly, you have a choice. Find more cash immediately or sell your position. When you are already looking at a falling market and you have hours to make that decision, most traders sell. They have no choice. And when everyone sells at once, prices crash further. By multiple accounts, JP Morgan appeared to close its silver short exposure almost perfectly at the intraday low on Friday. COMEX delivery data shows JP Morgan was heavily involved in February deliveries, totaling 633 contracts at $78.29. That price, $78.29, was essentially the bottom. The exact bottom of a 35% crash, the largest short player closing their position at the mathematically perfect moment. Let me ask you something. What time is it where you are right now? Morning, afternoon, middle of the night? Drop it in the comments. I want to know when people are engaging with this content. Are you staying up late because you know this information matters? Are you watching first thing in the morning before markets open? Let me know. Now here is where it gets even more interesting. On the same day as all of this was happening, Reuters published a report claiming the United States was stepping back from plans to guarantee a minimum price for U.S. critical mineral projects. This headline hit the wires, and algo-driven selling systems immediately triggered. Automated trading programs read that headline, interpreted it as bearish for metals, and began executing sell orders. Mass sell orders hitting COMEX, while systems at LME and HSBC were down and margin calls were forcing liquidation. But here's the thing. The U.S. Department of Energy later publicly stated that the Reuters report was, and I quote, false and deliberately misleading. Let me repeat that. The government agency responsible for this policy said the report was false and deliberately misleading. Those are very specific words. Not inaccurate, not mistaken, deliberately misleading. Why would someone deliberately mislead the market about a policy that would trigger automated selling in an already fragile metals market? Who benefits from that? The answer to that question is whoever was short silver and needed prices to fall so they could close their positions profitably. And according to the data, JP Morgan closed 633 contracts at the exact bottom. Now, I want to be very clear here because I always present both sides. None of this proves a single coordinated conspiracy. Correlation is not causation. Systems can go down due to legitimate technical problems. Margin hikes happen during volatile periods. Reuters reporters can make mistakes. All of these things can happen independently without any coordination. That is the innocent explanation. And it might be the true one. But let me give you some historical context that I think is important. This is not the first time something like this has happened. Not even close. In 1980, the Hunt brothers tried to corner the silver market. They accumulated a massive long position in silver. Prices spiked dramatically. And then the exchanges invoked what were called liquidation-only rules. These rules effectively banned new long positions. You could only sell. You could not buy. With only sellers and no buyers, prices collapsed. Silver crashed about 80% as margin calls cascaded through the system. The Hunt brothers were destroyed, and the shorts who were on the other side of that trade made fortunes. In 2011, after the global financial crisis, silver ripped from roughly $18 to $49. It looked like it might break $50 and keep going. And then CME raised margin requirements 5 times in 2 weeks, 5 margin hikes in 14 days. Silver promptly halved as leveraged longs were flushed out of the market. The same pattern, margin hikes forcing liquidation, prices crashing, shorts covering at the bottom. December 2025 already looked like a rehearsal for what happened in January 2026. There were margin adjustments then too, volatility spikes, suspicious timing. It looked like someone was testing the playbook. What is different about 2026, and this is critical, is that this does not look like a purely speculative bubble being popped. The silver market has allegedly run a roughly 164 million ounce annual supply deficit for 5 consecutive years. This is not speculation. This is physical demand from solar panels, electric vehicles, and AI-driven data centers exceeding physical mine supply for 5 straight years. The deficit is real. The demand is structural. This is not tulip mania or a meme stock pump. There are fundamental reasons silver prices should be higher, and yet the same pattern plays out. Prices rise, margin hikes come, systems glitch, shorts cover at the bottom, prices crash, longs get destroyed, and then prices slowly recover until the next time. About 60% of you watching right now are not subscribed to this channel. If this kind of analysis is opening your eyes to dynamics that mainstream financial media never discusses, consider hitting subscribe. I do not sell hype. I do not sell fear. I present evidence and let you make your own decisions. If that approach resonates with you, subscribe. Now let me talk about the paper to physical ratio, because this is at the heart of why many believe the silver market is fundamentally broken. Analysis of early 2026 pricing shows COMEX silver trading far below physical prices in Shanghai. We have talked about this premium before. Shanghai silver was trading at massive premiums to New York COMEX prices. One study describes a 350 to 1 paper to physical ratio in silver contracts. Let me explain what that means. For every 1 ounce of actual physical silver that could theoretically be delivered, there are allegedly 350 ounces worth of paper contracts trading on exchanges. That means if everyone who held a paper claim on silver demanded physical delivery at the same time, there would be nowhere near enough metal to satisfy those claims. The paper market is many multiples larger than the physical market it is supposed to represent. That imbalance has long fueled allegations that a banking cartel uses synthetic paper supply to suppress prices. By creating paper silver out of thin air, you can meet demand without having to source actual metal. You can keep prices lower than physical supply, and demand would otherwise dictate. And when prices threaten to break out, When physical demand starts overwhelming the paper fiction, you can use margin hikes and system glitches and conveniently timed news reports to crash prices back down, flush out the longs, and reset the game. In the immediate aftermath of the January crash, multiple observers predicted widespread physical silver shortages at dealers. That prediction was made on Friday. By Sunday, February 1st, widespread dealer shortages had materialized. Physical silver was difficult to impossible to source at major dealers worldwide. The paper price said silver was worth $78. But you could not actually buy physical silver at that price because there was none available. This disconnect between paper and physical is the clearest evidence that something is fundamentally wrong with how the silver market operates. Paper says one thing, physical reality says another. And when they diverge this dramatically, one of them is lying. Quick question for the community. How many of you have tried to buy physical silver in the past week? Were you able to get it at prices anywhere close to the COMEX spot price? Or were you paying massive premiums? Or were you told there was nothing available at any price? Drop your experience in the comments. I want to hear what the actual situation is on the ground. Now I need to address something that gives the manipulation narrative significant credibility. JP Morgan has been caught manipulating precious metals markets before. This is not speculation or conspiracy theory. It is legal fact. The U.S. Department of Justice and CFTC fined JP Morgan $920 million for manipulating gold and silver prices over 8 years between 2008 and 2016. $920 million. That is nearly $1 billion fine for doing exactly what critics accuse them of doing now. The traders involved used a technique called spoofing. They would place large orders they never intended to execute to move prices in a desired direction, then cancel those orders once they had manipulated the market. They did this systematically for 8 years. They got caught, they paid the fine, and then, according to the evidence from January 2026, they may have done something similar again. Or maybe not. Maybe this time was completely legitimate. That is for you to decide. But here is what I struggle with. If you got caught robbing banks and paid a massive fine, and then another bank got robbed using the same techniques you used before, would it be unreasonable for investigators to take a close look at you? Past behavior is often the best predictor of future behavior. JP Morgan has a documented history of manipulating precious metals markets. When suspicious activity in precious metals markets occurs, and JP Morgan appears to benefit perfectly from it, it is not irrational to ask questions. Now let me present the mainstream counter-narrative fairly, because I always show both sides. The official explanation is that silver was in a speculative bubble. Prices had risen too far too fast. Leveraged long positions had built up excessively. When macro conditions shifted with the Warsh nomination suggesting a more hawkish Fed, the dollar strengthened and over-leveraged positions collapsed under their own weight. The system outages were unfortunate coincidences. The margin hikes were prudent risk management by exchanges facing extreme volatility. Reuters made an honest mistake that was later corrected. And JP Morgan closing shorts at the bottom was just good trading by skilled professionals who read the market correctly. That narrative is internally consistent. It explains the events without requiring any coordination or conspiracy. And it might be completely true. Markets crash. System glitches happen. News services make mistakes. Skilled traders make money. None of this requires a conspiracy to explain. But there are problems with the innocent narrative. The timing of all these events happening simultaneously stretches coincidence to its breaking point. The precision of JP Morgan's exit at the exact mathematical bottom seems improbable without advanced knowledge. The government's statement that the Reuters report was deliberately misleading implies intent rather than error. And the historical pattern of margin hikes, being used to crush silver rallies in 1980 and 2011 and now 2026, suggests a playbook that gets repeated. The most provocative claim from analysts examining this crash is that this was not a failure of the silver market. It was a feature. The modern metals market is designed to allow exactly this kind of reset. Paper markets trade at 350 times the size of physical markets. Exchanges can hike margins at will to force liquidation. Systems can go down at critical moments. And the largest players can position themselves to profit from the chaos they help create. Whether you buy the full cartel narrative or not, the data points are real enough to justify hard questions. Who benefits from a Six Sigma metals event that conveniently lets the largest short players close their positions at the lows, while headlines blame it all on a Fed chair nomination and investor irrationality? Let me ask you directly, what do you think happened? Drop your take in the comments. Do you believe this was a natural market event or something more deliberate? I genuinely want to know what this community thinks. Now let me talk about what this means going forward, because understanding the game helps you position appropriately. If the cartel narrative is correct, if paper markets are used to periodically reset prices and flush out long positions, then the implications are significant. Paper silver instruments may never be allowed to reach their fundamental value as long as the paper to physical ratio remains at 350 to 1. Every time prices threaten to break out, the same playbook gets executed. Margin hikes, system glitches, conveniently timed news, prices crash, longs get destroyed, shorts cover, reset complete. In this view, the only way to benefit from silver's long-term fundamentals is to hold physical metal that cannot be margin called away from you. Paper instruments are playing on a rigged table. Physical metal is the only true claim on the actual asset. However, if the innocent narrative is correct, if this was just a speculative bubble that popped naturally, then paper instruments are fine and the crash represents a buying opportunity. Prices overshot on the way up. They overshot on the way down. Eventually, they will find equilibrium at something like fair value. Patient investors who bought the dip in paper or physical will be rewarded. The fundamental picture has not changed regardless of which narrative is correct. 164 million ounce annual supply deficit for 5 consecutive years. Demand from solar panels growing exponentially. Demand from electric vehicles growing. Demand from AI data centers growing. Mine supply not keeping pace. These fundamentals are real and they support higher prices over time. The question is whether the paper market will ever be allowed to reflect those fundamentals, or whether the reset button will be pressed every time prices threaten to break out. 3 key takeaways, and then we are done. Number 1. The sequence of events on January 31st, 2026 raises serious questions that have not been adequately answered. The London Metal Exchange experiencing glitches at market open, HSBC systems going down simultaneously in Hong Kong, CME hiking margins aggressively into thinning liquidity, Reuters publishing a report the government later called deliberately misleading, and JP Morgan closing 633 short contracts at exactly $78.29, the precise intraday bottom of the worst silver crash in 44 years. Any one of these events could be coincidence. All of them happening together stretches that explanation thin. JP Morgan has paid $920 million in fines for manipulating precious metals markets before. When similar patterns appear, questions are warranted. Number 2, the historical pattern is undeniable. In 1980, silver crushed via liquidation only rules and margin calls after the Hunt brothers tried to corner the market. In 2011, silver halved after CME raised margins 5 times in 2 weeks, following a rally from $18 to $49. In 2026, silver crashed 35% after margin hikes, system outages, and a misleading news report. The playbook appears to be the same. Prices rise, longs accumulate leveraged positions, margin hikes force liquidation, prices crash, shorts cover at the bottom. The players who control the margin requirements and the trading systems appear to control the outcome. Number 3. The fundamental case for silver remains intact regardless of short-term manipulation. 164 million ounce annual supply deficit for 5 consecutive years. Growing industrial demand from solar, EVs, and data centers. Physical premiums in Shanghai far exceeding Western paper prices. Widespread dealer shortages when paper prices crash. The disconnect between paper and physical is at extreme levels. Eventually, fundamentals assert themselves. They always do. The question is how you position to benefit when that happens. Physical metal cannot be margin called. Paper instruments play on a table where someone else controls the rules. Decide accordingly. Let me leave you with this thought. Markets are supposed to be mechanisms for price discovery, where buyers and sellers meet to determine fair value based on supply and demand. When paper markets trade at 350 times the size of physical markets, when margin requirements can be changed overnight to force liquidation, when trading systems can go down at critical moments, when media reports can be deliberately misleading to trigger algorithmic selling, price discovery becomes something else. It becomes price control. Control by whoever has the power to change the rules, shut down the systems, and place the trades at the perfect moment. Whether that control is being exercised deliberately, or whether all of this is just unfortunate coincidence, is something each person has to decide for themselves. I have presented the evidence, the timeline, the historical pattern, the data, the mainstream narrative, and the alternative explanation. What you believe is up to you. But I will say this. If you are holding paper silver and the same thing happens again, you will be on the losing end of that trade. If you are holding physical silver, you still own actual metal regardless of what the paper price does. There is a difference. And in times of extreme volatility and questionable market mechanics, that difference matters. Do your own due diligence. Understand the risks. Be accountable for your own decisions. Have a clear plan and know your time frame. Are you trading paper instruments on short-term charts, or are you accumulating physical metal on a decade-long thesis? Your answer determines how you should interpret everything I have told you. Plan and position accordingly. If you are using leverage, margin hikes can force you out regardless of whether you are right about the long-term direction. If you are holding physical with no leverage and a long time horizon, You can weather any storm. But if you do not understand the game you are playing, you will lose. Drop your thoughts in the comments. Where are you watching from? What do you think really happened on January 31st? Are you holding paper or physical or both? I read every comment, and they help shape what topics I cover next. The game continues. The players remain the same. Only the dates change. Stay sharp, stay informed, and never stop asking questions that powerful people do not want you to ask. This is MSAR AG, Asian Guy, bringing you the complete picture. I will see you in the next one.